The S&P 500 was up 0.53%, closing at 6664.01 during Friday's trading session. Friday was also the big monthly options expiration for October, and even though on the surface it seemed like a pretty relaxed OpEx, there was a lot happening underneath the surface that I want to take a look at in today's video. So definitely stick around. We've got a lot to cover here. But first, I just want to take a look at this range from the previous Friday where we saw the big sell-off in the markets. The Friday before last saw the S&P 500 drop from the 6750 level all the way down to 6550, so a 200-point drop in just a matter of a couple of hours. Ever since then, the market has been oscillating within that range. Volatility picked up quite a bit in this last week, but we still have not broken outside of that range, either to the downside or to the upside. So I think this next OpEx cycle is going to be a key factor in the next leg of this bull market run that we've been in. So now let's talk about how option dealers are positioned. We see the largest gamma exposure concentration still at the 6,700 strike. This is going back now for the past couple of months. The 6,700 strike has been a large factor in the market. We've seen large positioning at 6,700. Even if you look at the options market volume on Friday, over 200,000 contracts traded at that 6,700 strike. So this is still a key level in determining where bullish momentum is currently sitting. This gamma exposure data set shows us how option dealers are positioned, and from that we can infer how they are likely to react in the market as price trades up or down. And what we've been seeing over the last week is buyers stepping in as the market has dipped. Basically, dips are still being bought as we oscillate within this larger zone that we were talking about earlier. Friday actually saw the market close in positive gamma exposure territory. If we come over here to our gamma exposure data graph, you can just see total gamma is positive now at 125 million. Volatility is elevated, so that is something to keep your eye on. We'll talk more about volatility here in a second. But overall, you can see gamma exposure even from the 6,000 strike up to the 7,000 strike. And so even though negative gamma exposure has picked up a little bit over the last week, we're still remaining in a buy the dip environment. And this is exactly what you would expect to see in a buy the dip environment. So pushing 6 months now, and that's a key factor in what option dealers are doing here at these levels. So coming back here to our main chart, we can actually see the effects of option dealers coming in and being forced to buy at these levels. So the 6550 level has been a really big level for the market in general. There's a huge support down here at this 6550 level, and every time we've dipped in there, part of the factor why we've seen such big bounces off of these levels is because option dealers are forced to buy down here at these levels. And if you just look at the gamma exposure data structure, that's because all the gamma exposure is positioned higher, concentrated mainly around this 6,700 strike. So the further down we go in this structure, the more option dealers are forced to buy underlying, or in this case, buying S&P futures or buying the SPY ETF, but essentially hedging their option positions by buying the underlying. So now what could change this buy the dip environment, and what could change option dealer positioning? Well, if we see further gamma exposure growing below those levels, like for example at the 6,500 level or the 6,400 level, that would actually serve as a downward catalyst, and we could see further selling pressure in the market as price goes lower. So if we saw a big break at this level, at the 6550 level, while simultaneously seeing gamma exposure growing at these lower strikes, that would be a big red flag signaling that option dealers are likely to become net sellers and add additional selling pressure to the market. That hasn't happened yet, and so we remain in a buy the dip environment. But I just wanted to point out that the 6550 level is a key level for option dealers as well as the market in general. Now, I mentioned volatility a couple of times. Let's take a look at the VIX. On Friday, the VIX was down a massive 17.9%. I didn't hear a lot of people talking about this, but the VIX closing at 2078. This was a huge move in volatility. I think volatility sellers came back really big during Friday's session. We did hit the 25 level on the VIX at the end of Thursday, kind of at the beginning of Friday's trading session, and that's a huge rejection that we saw from that level. So one of the areas that we are watching on the VIX in particular is this 1850 level. If we see further vol selling and we get back down below 19 into the lower 18s on the VIX, For all intents and purposes, that's going to show us that vol sellers are firmly back in control of this market. And that's a huge signal for bullish momentum to potentially resume into the end of the year. So we're not there yet, but that is a key level that we're going to be watching into this next week. By the way, if you want to get a sneak peek of what we're talking about and what we're trading, you can check out our community Discord. I'll put a link in the description below. Next, let's take a look at a few individual names that we are actively trading. I'm going to start off with Tesla. Tesla was up 2.46% during Friday's trading session, closing at 439.31. We've been talking about Tesla quite a bit over the last couple of weeks, and we've seen this consolidation forming just below the 450 strike. As you know, if you've been watching our YouTube videos, gamma exposure has been concentrated between the 450 strike and the 500 strike. Those have been the two largest GEX concentrations, and we've been eyeing a near-term consolidation right at this 450 strike, expecting price to kind of hover around this level for the next several weeks. We basically got that over the last 2-3 weeks, and 500 is now becoming the largest gamma exposure concentration. And we actually closed out our Tesla iron butterfly position during Friday's trading session, locking in $853 profit. We had the 425, 450, 475 iron butterflies. And so that's basically a strategy that targets premium collection and theta decay within a specified range. So of course we wanted to see price stay between 425 and 475. The closer we got to that 450 level, the better it would be for our position. And if we go back to our original post as we initiated the position, this was actually back on September 25th. So we've been in the position for about 3 or 4 weeks now. The trade idea was basically selling the October 17th 425, 450, 475 iron butterflies at $21.25. So we had a pretty big max profit potential on that trade. And just look at the gamma exposure setup at the time. This is why we opted for a premium collection strategy. That GEX at 500 was already there even back 3 or 4 weeks ago, showing that market participants are positioning for further upside in Tesla. But you got to be specific at what expiration are most of these contracts in. And as we look at our 3D gamma exposure surface model, most of those contracts are in later expirations towards the end of the year. So we also saw a lot of gamma exposure at these lower concentrations between 425 and 450. And most of this GEX was concentrated in the October 17th expiration. And that basically helped inform our decision, helping us to decide what type of option strategy to employ to take advantage of that. And so Tesla was trading at 424.04 at the time, and we opted for that iron butterfly, expecting Tesla to kind of just chop around that 450 strike for the next several weeks. And that's exactly what happened. So coming back here to our current chart, that was a really great trade on Tesla, but I do think the setup has shifted quite a bit over the last couple of weeks. We're seeing a rising 50-day EMA, and we're seeing price consolidating right into that level. So there's going to be a key decision point here, I think, in the next week or two on whether or not Tesla is going to make another leg higher up towards that 500 strike. We think the probabilities are rising for a move up towards that 500 strike, and we're going to be positioning for that by taking a trade in our portfolio, most likely an out of the money call debit spread targeting a move towards that upper end of that range. And guys, you can actually track our trades in real time by becoming a member at geeksoffinance.com. I'll put a link in the description below for you guys to check out. Next, let's take a look at Micron. Micron trading just above the 200 level. We saw a big breakout early in September, and since then it's just been on an absolute tear. And when we look at the gamma exposure data, it's basically telling us that traders believe there is still more upside to go. We see positioning not only at the 200 strike, but also all the way up to the 250 strike and beyond. And so we're actually looking to add this to one of our portfolios on the next pullback. We're tracking this 50-day EMA and looking for pullbacks back into that big moving average. If we get one of those, which would put price probably below this big 200 level, that would be an interesting buy the dip opportunity for a swing trade into year end, either into the November 21st expiration or potentially into the December expiration for the next leg higher. For another potential leg higher into year end, we're starting to see gamma exposure grow at these higher strikes. And so that can overwhelm a lot of the selling pressure that we could potentially see above the 200 strike. If you notice, we've been seeing that dealer selling pressure kicking in over the last week or two. However, the fact that we're starting to see volume pick up here above the 200 strike tells me that a lot of this buying pressure that we're seeing from traders and investors could potentially overwhelm the dealer selling pressure that we're seeing currently above this 200 strike. So that's something that we're watching very closely for. On the next pullback, I think that makes sense from a risk reward perspective to enter a position for another leg higher. But this is something that is definitely going up to the top of our watch list. And guys, we are running a limited time promotion. You can get $300 off our yearly portfolio manager tier subscription. Use code FALL2025 at checkout. We have a few spots available, but this promotion is going to be ending soon, so definitely take advantage of it while you can. Members get full access to our gamma exposure dashboard, our option flow analytics tools, as well as our algorithmic trading strategies. And you'll also get access to the premium channels in our community Discord. We've got a ton of great traders in there sharing their own trade setups and strategies. And you can also track our trades in real time as we manage our options portfolio. I'll put a link to all of that in the description below so you guys can check it out. Thanks so much, everybody, for watching, and we'll see you guys in the next video.